Today I have the pleasure of speaking with Chris Ecclestone. He's the analyst and founder for Hallgarten. How are you today, Chris?
I'm great, thank you.
Well, thank you for taking the time to speak to us, in addition to providing a lot of informative and compelling information in your regular columns on InvestorIntel. You did a piece recently on dark pools and HFT trading. So
Yep.
if you wouldn't mind, could you start by explaining what dark pools are and how that actually works?
Dark pools are really an invention of probably the last 7 or 8 years, where the brokerage industry, sort of in cahoots with the hedge fund industry, have developed a means for trading blocks, where the blocks are not seen in the market until the deed is done, the trade is closed, and the stock has all been disposed of. And then suddenly the market is revealed and seen that this transaction's taken place. But by that time, most people have sort of missed out on the opportunity to take some of the stock.
So you mentioned in the article that it has the power to turn the markets into second class markets. Can you explain what you mean by that?
Absolutely, because up until the development of these dark pools, the institutions that had a large block to sell would mainly be putting that stock through the market, and that would be flow. It would be stock that the blocks would be broken up, and then the public would get to see them, buy them, react to them. At the moment, the investors don't get to see that, and don't get to have a go at buying that part of those blocks.
Okay, so specifically in the current marketplace, I'm just a regular investor. I'm guessing that, dark pools don't affect the microcaps, for instance, or do they?
They do. They do very much. If you go to something like Stockwatch and you get your tickers and your trades from there, you'll see occasionally CHI-X, CHI-X, as one of the exchanges, and you can see actually quite small Canadian traded stocks having blocks translated on this on that market, and that is one of the dark pools.
Okay, so for instance then, so I'm not safe if I'm just investing in, say, the micro caps from the impact of some of these technological advancements in trading. Is that correct?
No, that's absolutely correct. You can still be linked in, even if you've got a stock that you think is very low market cap and low volume, they can still see some of their volume ending up in these dark pools.
In 2008, when the market crash happened, there was a lot of conjecture on the street that perhaps, spiders and some of these technological trading tools were responsible for what had happened with the marketplace. What are your thoughts on that, Chris?
No, I'd agree with that. On those particular days when the market was at its worst, in the days when Lehman was collapsing, etc., Bear Stearns, you saw almost the market and the market systems took over from real people, and things were being driven by factors, at least from the outside, it looked like had no human contact involved in the whole process.
I frequently receive emails from newsletter writers and investors saying, this company's got money in the bank, they've got liquidity, they have got revenue, it's a great story, but for some reason the stock is not moving. And one CEO in particular, when I asked him what he thought was the reason his stock wasn't moving, he said to me that he felt he was being victimized by dark pools. Now, how would a CEO come to that conclusion and know that they were actually indeed the victims of dark pools, for instance?
I don't know that he's correct in calling himself a victim of dark pool, but he may have his stock being damaged indirectly by what's going on in the dark pools. I mean, it's sort of ascribing in that argument that there's the dark pool has a brain and that the dark pool is vindictive. It's not really like that. But what is happening is, for instance, if he wants institutions to be buyers of his stock, unless his stock is being shown in the dark pools, then maybe his stock won't get traded. Maybe he's got too many odd lots moving around in there. The way that he can tell, though, whether high-frequency trading is going on is if he's seeing massive amounts of small trades, all of the same size, like 500 share blocks going through for hours and hours and hours, then he will definitely be onto something and correct in assuming that he is being subject to high-frequency trading. Whether that's vindictive or not is another matter.
Of course, in your article, you write that high-frequency trading and dark pools are often confused as the same thing, and they are not. Would you like to clarify a little bit about high-frequency trading?
No, absolutely, that's true. Because the dark pools were developed to move chunky blocks of stock between one party and another party. The high-frequency trading actually works on a totally different principle, which is that if they can break up the trades to a small enough level, they can send them through the market sort of under the radar in bite-sized pieces that the market will consume, and then they're put together by somebody on the other side. So dark pools, big blocks, high-frequency trading, mainly smaller sizes, but a lot of them.
Okay, so if I am an investor and I'm investing in a stock and it seems to have a ceiling that it can't break through, how would I be able to conclude, for instance, that this company was the recipient of numerous HFTs or dark pools?
It could be, and this is where the hedge funds come in, that the hedge funds might be using the dark pools or the high-frequency trading as a means of disguising shorting. And there's no real reason why high-frequency trading in itself should stop a stock from going up if the stock is in demand. The only way that that would happen would be if there is some sort of program trade working against the company's positive tendency. And I would think that that would be because of some actual decision made by a large investor to short or to sell into strength. I don't think that high-frequency trading in itself will keep down a stock price if that stock price is wanted to be bought by someone out there.
Well, you just made
more buyers and sellers.
Well, you just made a critical point to me anyways. So if a very high-powered investor or a hedge fund, for instance, decide that they want to create a formula to trade against a stock and to keep that stock's prices down, do they have the capacity to do that, Chris?
Up to a point. Always if there are far more buyers than sellers, the stock will rise. But if the market's pretty balanced, they could give a negative tendency by making it look to the market as if there are a lot of sellers out there, when in fact it's the one seller breaking his position up in his position, whether it's a short position or a real position that he's selling, into a whole lot of little blocks and tossing them through the market, which gives people the impression, wow, there's a lot of sellers today. Maybe only one seller.
Well, as you know, Chris, there are numerous technological advancements that are coming out every day towards assisting traders and investors in increasing their portfolio values. And we hope that you'll join us regularly to keep us informed.
I would be very happy to. Thank you.